Thank you so much, Lisa, and thank you, Berkeley and CEDAR, for hosting me once again over Zoom. I'm quite happy that this is feasible because a trip does not look any likely anytime soon. So I am talking about a paper that Julia and I wrote literally during lockdown. I think we started first week of lockdown and finished it before our kids went back to school. So we call this our little lockdown paper. It's called The Anatomy of Sustainability. And before I go into the details of what this paper is about, what we mean by anatomy of sustainability, I thought of motivating it, at least chronologically for now. So this is a paper about Corona, COVID. Unfortunately, I'm a bit tired of hearing talks about COVID, so I apologize for that if you've heard so much about Corona lately. But it really started when the market started to crash. So this is something people refer to now as the Corona crash. The market peaked on 20th of February 2020. What I have here is the price movement of the S&P 500. Then there was a big drop on Monday, the 9th of March, which people now refer to again, as always, as the Black Monday. I think I just read the other day that this is the largest drop since the Black Monday or Black Thursday of 2008. I don't remember which day of the week that was. And so we in Switzerland, Julia and I, where we're based, we went into lockdown 16th of March. So really in the middle of that crash, where we didn't know how long this was going to last. And we were lucky enough that we were working on a subject related to sustainability. So we had a lot of data, a lot of sustainability ratings, lots of price data for over 1,500 companies. And what triggered this project was really right in the middle of this lockdown, we came across tons and tons and tons of news items from quite prestigious newspapers, the FT, from Reuters, from the Wall Street Journal, all of them saying that and that was actually, let me go back a slide. So these newspaper articles started coming out that week of 16th of March. So it's really, I'm referring to things that were said during the last 2 weeks of March. So really, we're still in the middle of this Corona crash. And the big claims they're making is that ESG, so stocks that have received this rating that says they are, for anybody that doesn't know what these are stocks that receive a grade, sort of, that tells the investors that they are sustainable, which means that they are scoring above average on things related to the environment, which is what the E stands for, social issues, which is what the S stands for, and governance issues, which is what the G stands for. So a company that has lower CO2 emissions, or has good labor practices in the firm, or they have a certain amount of female women on executive boards, they would score relatively high on that scale. So, and the big claim is that in the middle of this crash, the companies that are performing better than the rest, or at least are proving to be immune or resilient, are stocks that have above average grades from these rating agencies that give these grades. And I'll come back to these rating agencies in a bit. But just to motivate this, so here Julia and I are sitting on top of all these data. We had looked at firms in the S&P 1500 index. So this is, we have 1,500 individual prices and lots of other fundamentals for these firms. We have ESG ratings for these firms, and we thought to ourselves, since we're sitting on top of this, why don't we check this for ourselves? Is this just anecdotal evidence? Are people saying things that they want to believe in, or is there some truth to that? So this picture here, again, something I'll come back to in detail a bit later on, we ran what is called an event study. So the idea here is that we use the history up to about the beginning of the crash, to estimate expected returns for all of these each time for each of these individual 1,500 stocks that we have. And we use these to estimate abnormal returns within the event window, which is for us just started from the peak, the 20th of February. And we cumulate, look at the CAR, the CARs, these are the cumulative abnormal returns over time. And we look at the average of these returns for 5 different sets of firms. The one where it says quintile 1 have on average the highest scores according to some sustainability criteria, and I'll get back to this in a bit. And then quintile 5 would be the worst scoring according to sustainability, the firms that are scoring the worst. And then some firms we didn't have any ratings for, but we decided to include them as well. And so we plot the average abnormal returns over time and actually find that what's been portrayed in the news seems to be correct for the ratings that we're using and for that specific set that we're looking at. So our first hunch is maybe it's not just anecdotal evidence. So I was quite skeptical at first. I thought there's absolutely no truth to that whatsoever. And it's nice that Julia balances me out pretty much everything in this paper. But we saw something that the newspapers were reporting about. And within a couple of months, several other papers came out. The main one that's been cited quite and distributed quite extensively is the first one, which is now entitled Resiliency of Environmental and Social Stocks, an analysis of the exogenous COVID-19 market crash, and which is forthcoming, or I think already published, at least online in the Review of Corporate Finance Studies. So what these guys did is something very similar to what we did in the picture here. They estimate also the abnormal returns, and then they ask the question, why? Why do we see this happening? I think they used MSCI, and maybe Julia can correct me if I'm wrong. They used the ratings from MSCI and then carried out a regression, cumulative abnormal returns against ESG with a bunch of control variables. And then they found something like firms that have higher advertising expenditure were more resilient. Firms that have a more loyal customer, investor and customer base were more resilient. Some financial conditions led to this resiliency as well, such as cash holding, the total debt, profitability, and so forth. And actually here is where my personal skepticism came in, and the main reason is this idea of sustainability rating. So there is no standard way today, and there are no regulations for the type of grades that firms receive for their sustainability practices, for their E, S, and G. And in fact, we have data from 7 or 8 now different sustainability rating providers. And there's this great paper that's making its way, I think, around the world now. It's not published yet, but it's co-authored by Julia's colleague, Julian Kölbel, and his co-authors at MIT, Roberto Rigobon and Florian Berg, that has that title, Aggregate Confusion. And what these guys do is they don't only show you that these rating agencies, the firms that are rated well in one and well in another, there's very small correlation between them. So they show this, but they also show that the methodology they apply for what type of criteria are being considered, how these criteria are being measured, and how these measures are being aggregated in the end, they vary significantly. And again, to state the source of skepticism is that a lot of these studies look to me like there's a random, to say it really, I know it's a strong word, there might be something to these ratings, but they seem random. One agency that says this company is good, different agency would say this company is bad. And then they use this rating to make a regression against several things that are within the firm and come to the conclusion. And I just find it very hard to believe any conclusion that says, if I spend more on advertising, then I'm going to get better MSCI scores. And this is really the root of this paper. It started with observing that certain firms are resilient. We see it as well based on several ratings we consider. And then the main question we are trying to answer in this paper is why exactly. And so this is why we talk about the anatomy of sustainability. And this is really a paper about these sustainability ratings that was inspired by the COVID crash and this research that came out of it saying sustainability is resilient. So our motivating arguments are the following. If somebody wants to draw a conclusion about sustainability, which a lot of papers are doing at the moment and over the past 10 years, I think we need to understand what, if anything at all, is encoded in the sustainability criteria that people are applying beyond saying MSCI has analysts that give grades to firms based on certain criteria. And based on the evidence that we see of our performance during the crisis, we actually think that there might be something to sustainability. So that there isn't a complete randomness there, but there is something encoded in them that led to the resilience. So I've come now after several months of researching this to the feeling that yes, maybe sustainability has proven more resilient, but I'm not convinced with the reasons I'm reading about so far. This is my personal skeptic point of view. So here's what we do. The anatomy of sustainability, this paper and this talk. We take a history of sustainability ratings based on several rating agencies. I'll talk in a bit about what exactly we do, which ratings we use. And we try to decompose it econometrically. We first take out anything that's firm intrinsic, the fundamentals, the size, the book to market ratio, accounting data. And then we decompose it into things that are driven by the market. And so our first contribution is we show that sustainability can be decomposed into something that represents uncertainty, something that represents investor sentiment, and an idiosyncratic term, which we refer to as idiosyncratic sustainability, which may or may not be true. So we call it like this for now, but there may be other information in there too. And then we revisit the crash based on this decomposition and say, okay, if we observe resilience, where is this coming from in terms of these three factors that we find? And then we find that most of it is coming from the uncertainty channel. Nothing almost is coming from the sentiment factor, and a little bit is coming from the idiosyncratic sustainability factor. And once we control for uncertainty, we see resilience persists, so it doesn't disappear completely, but it's a weak resilience, so it's not as shooting up like some of the other pictures that we will show in this paper. I don't know if I should pause here before I start with the data and the econometric methods. I don't know if anybody has questions.
Hi, Ola. Yeah, I did. So your ranking, you said that when you divided it into quintiles, so each vendor, whatever, they have, their rankings aren't correlated with each other. What did you use to do that?
To divide it into quintiles?
Yeah.
I'll come to this in a bit.
Okay.
Yeah, I'll come to all the details. I just couldn't resist showing that picture to do a chronological motivation, so to speak. But yes, I'll come to this in a bit. So actually, let me get right to it. So this is the data that we have been sitting on, which allowed us to really get started on this right away. We had basically 4 data sets. We have our equity space. When we decided to pick the constituents of the S&P 1500, we didn't want to take the S&P 500, mainly because we wanted to include a bit of smaller stocks as well. It covers more of the US market cap. And for these, we have stock prices, bid-ask spread, and trading volume from CRISP, thanks to Julia. Then we have firm fundamentals, quarterly accounting information, usual things, size, leverage, cash, idiosyncratic volatility. We got through the Fama-French factors. Then we also include implied volatilities. I'll explain why in a bit, from the option metrics database. For each firm, we are basically given the implied volatilities from this database. We didn't need to do much calculations. We took the average of all the available at-the-money put and call options on each trading day, and this average, we call it the IV, the implied volatility of firm I at point in time T. And then the all-important sustainability data. So like I said, we have, thanks to CEDAR and thanks to Julia, we have gotten for free data from now 8 different rating agencies. So the big traditional ones like MSCI, Sustainalytics, I think we even had RobecoSAM, the old KLD, all the things you read about, and then these 2, Owl Analytics and True Value Labs, which we decided to use in this paper for reasons that I'll explain now. So Owl Analytics, one thing that's different from other traditional rating agencies is they aggregate scores from different rating providers, from different government agencies, from different publicly available information. So there isn't an analyst sitting there saying, analyzing it firm by firm, but they take data that is given to them by rating agencies and aggregate across them. They have 12 categories divided into various environmental, social, and governance indicators. Then they average these indicators into E and S and G, and then they average them into an overall ESG score. They have monthly data covering over 25,000 companies, and their coverage starts a decade ago. So this is a pretty nice data set. We're only using a fraction of it because we're looking at constituents of the S&P 1500. So one of the main reasons we're using Owl Analytics is we actually looked at the correlation between Owl Analytics and some of the other rating agencies and found them to be quite strongly correlated. And my intuitive reason for that is that these are subsets of Owl Analytics. They're already included in there. And when we, at the beginning, carried out our analysis for various rating agencies, we didn't find a huge difference in the results. So things were quite robust. And we decided not to include the other rating agencies that are within Owl Analytics for now. But we did decide to take True Value Labs because their methodology is very different. They rely on public data and mainly news analytics. So they analyze these news incidents using natural language processing and artificial intelligence and come out of that with an indicator that says this company is scoring on a scale from 0 to 100 this high based on the news sound or noise around it these days. They don't have separate E, S, and G indicators, but they have 26 different ones spanning these 3 categories. They have 4 different scores. We're using their insight score. So this is a sort of exponentially weighted, I think, average of their daily pulse score. So on a daily basis, they have a score based on the news they see, which is quite noisy. We're using the smooth one of these. Again, large number of securities in there, also a decade where it starts. And our ESG score that we use in this paper is an average of the monthly OWL and the monthly True Value Lab scores. Again, we did carry out our analysis for OWL alone, TVL alone. I think at the beginning, Sustainalytics alone. Lately, we included MSCI in there, and the results don't vary dramatically again, which was very surprising to me. So this is the data set we use. We merge everything, and our analysis, unfortunately, for the decomposition of these scores starts January 2017 and ends June 2019. So the reason it ends in June 2019 is because our implied volatility data ended then, and we really wanted to include them there. We didn't want to continue without them. The reason we start in 2017 is if we take one more year back, we lose a dramatic amount of data. So we really wanted to stay around 1,000 per year, but even in 2017, we have an average of 780 stocks per date. And we didn't want to introduce a bias towards the stocks now. So this is what we have now, and I think Julia and I would really like to extend this in the future and take it longer history back. And now to the baskets. Sometimes we look, sorry?
Sorry, can I interrupt with a question? So
Yeah.
I mean, going back to January 2017 in a sense seems not crazy at all, because the landscape's changing so quickly in ESG, and recent conclusions might be the conclusions based on recent data might be the only valid ones, but 2019 seems to miss the recent crisis ending.
The Corona crisis.
Yes.
Yeah, so this is we're decomposing pre-event and then using that information to feed into the event. And we couldn't stop in December because we didn't have the data until December.
Okay.
Yeah. So this is the first part before the crash. We're just trying to understand before the crash if there's any information in these scores that may help explain what's happening later in the future. But actually, Julia just found the implied volatility data. They were published until end of December. So we have some work to do to incorporate these. So these baskets we form, not always, but also in the pictures that I'll show in a bit, we have these, we divide up for a given year. We look at the average score of a firm in that year. So say we're 2018, we create an average score based on an exponentially weighted moving average of monthly aggregate ESG scores. And then we rank all our firms for that year from 1 to say 1114 for 2019. And then we say these top 10%, we're going to put them in a basket and call this the decile number 1. So these have the best scores, and decile 10 would be the ones with the worst scores. And we do this also for quintiles later in the study. So I don't know if that answers the question earlier of how we form these different baskets.
So this is the question from before.
Yeah, that's the question from before.
Yeah.
Yes, so this is on the data. Now, why do we want to do this decomposition? So the first hypothesis we have is there is some information in sustainability scores, even when you take out all the things that are firm intrinsic, things like the size of a firm or how much cash they have, or all of these things that the corporate finance literature analyzes in their various regressions. And again, this hypothesis is a bit difficult to explain, but we think just very roughly that there is something to sustainability scores that's bigger than what a firm is doing on its own, but it's more related to how the market perceives it to some extent. And so we are trying to come up with something like a factor model where we say sustainability can be decomposed into something that looks like alpha times F several times plus an idiosyncratic term. And now the question is, what would these factors be? And this is our second hypothesis. Based on, I'll motivate why we're picking uncertainty and sentiment based on empirical and experimental evidence and maybe an intuitive sense for why these things could be related. So in this paper, we say the first factor is something called uncertainty. How risky is a firm and how is its risk perception from the market and from investors, and investor sentiment. What Julia and I are thinking lately is that there's potentially a temporal factor in there, because at least when you talk to people or practitioners especially, they tell you that there is a perception of sustainability that this is more long-term. So somebody that would invest in something sustainable may not want to sell it within a year or two, but maybe like it's big here in Switzerland now, pension fund investments, that when you put your own money in the pension fund, or if your work puts money in the pension fund, that it's being heavily marketed to put your money in something sustainable, and it's quite successful. People seem to want to do that, and I'm guessing my question to anyone who maybe knows is, I wouldn't know where to start to measure this temporal dimension of an investment beyond maybe turnover, something Julia was also talking about the other day. I don't know if there exists a factor that captures something like this in the literature. Anything other than turnover?
Oh, could you be more clear about the question, please? So turnover as a measure of what?
Of how long investors are holding on to a certain firm or a certain investment.
Oh yeah, turnover is the standard practitioner measure.
Sorry?
Turnover is the standard in
turnover is the standard measure. Okay, there isn't a risk factor or something like this that has been developed.
Yeah, the one other thing is you could look at the at individual stocks and the average length of time in the portfolio. I mean, this is like an inverse of the turnover. It is slightly different information, but portfolio turnover is aggregate. But this can just say longevity of a stock in the portfolio.
Okay.
So, for example, if you have a few stocks, many stocks are just sitting there, but a few stocks come in and go out often. The mean is all that the turnover will capture, but you may want to look at the median of what each stock is doing.
Okay. No, thank you for that. Because again, I think it's one of the things where I think there may be some truth to that, but I think experimentally I may have an idea of how to capture this. I think it's maybe pretty standard for anybody that knows how to run experiments, but just looking at data, we didn't think of it at the time, but I think it's something where we want to explore now. But now to motivate, I don't know if it's another good point to stop for questions or I should continue.
I actually just, I was wondering if short interest ratio can also be a measure of holding a company. Not sure about it, like short interest ratio.
Short interest ratio, what is that exactly?
It's actually a ratio of the amount of stock shorted with respect to something about the volume, I think.
Okay.
So it's on like shorten the stocks. And I have a few questions. You said that you averaged the True Value Lab scores for the ESG measure. So those scores are updated on a daily basis. So do you actually take the average over the whole month and then take the average at the end of the month, or just take the values at the end of the month?
We tried a lot of things. So we did that first, and then we decided to take an exponential weighted average. And we stayed away from the very noisy first one. I know you guys, you and it's Saad, right?
Yes.
Yes. I know you and Lisa did use the same data set, but I don't remember if you used the monthly or daily.
So we used the daily at the end of the month, but we skipped the volume. We used the 12-month trailing volume. So it's like the average.
Yeah.
I think also we skipped the pulse because it's also it's on a daily basis, and the insight already takes the pulse to somehow smoothen it.
Exactly, yeah. So we were basing it on the insight, and I think we averaged that as well. I think that's already exponentially weighted I have to check. We started with a normal average and then we put some weights on more recent.
Okay.
Okay, so let me motivate why we think uncertainty and sentiment may play a role. So the idea that risk and sustainability are somehow associated exists in the literature. But we looked at that ourselves too. So without looking at any forecasting capabilities, we just want to see, we're not saying risk implies sustainability or sustainability implies risk. There's a lot of papers that look into that. I know there's the negative result that it doesn't bring anything to forecast maximum drawdown. But we just wanted to look at the pure association. So what we've done here is we looked at these decile portfolios of ours. So decile 1 contains all the really good or well-rated sustainability firms. Decile 10, all the bad ones, the brown ones. So from green to brown, 1 to 10. And for each of these, we looked at the daily history over our period 2017 to mid-2019. And we take a firm and look at its volatility over that period. So we get one number, and we get a lot of numbers for all the other firms in that same basket. We average over that number, so that number is a risk measure, and we plot it in here with the error bars. And so we do the same for all the different firms and all the deciles. So decile 10, we have, say, 100 different firms in that basket. We look at its risk measure. The risk measure of all the different firms in that basket, we average over to them, we get a point on the graph, and we get the error bar that comes with it. We calculated annualized volatility, so this is over the period, our period, 2017 to 2019. We looked at skewness and kurtosis for completeness. We looked at tail risk measures, expected shortfall and maximum drawdown. We looked at autocorrelations, which I call kappa here. We looked at implied volatility based on our option metrics data. We looked at something that I want to skip over for now, ambiguity. And I'll come back to this in 1 or 2 slides, I think. And we looked at the idiosyncratic volatility. And the picture that emerges is that it seems that the firms that are highly rated in terms of sustainability have lower volatility, lower expected shortfall, lower implied volatility, maximum drawdown, even serial autocorrelation, and relatively lower idiosyncratic volatility compared to at least the ones higher up in the worseness part.
So can I ask a question, Ola and Julia? That you said you were going to be telling us more about what's in these quintile or decile portfolios, but have you looked at industry composition of them or market cap?
I have to pass this question to Julia. I think we did, and we may have it in the paper. Was there a size bias and sector bias in the...
We actually just started to run this analysis because we also received this feedback, and we are right now looking into that, whether it's all the tech companies in the best quintile, for example. With the size, we don't have much of a bias, but it could be that we have it in the industry. But we are right now testing this.
Okay, thank you. I'd look very forward to those results.
Yeah.
So please put me on the list. Thank you.
I also have a question with regard to implied volatility indicator. Do you take equally weighted over the span of the strikes? Okay, because
Yes.
like usually some of the other measures is to weighted by the number of contracts for each.
Yeah, exactly. So I am anything but an implied volatility scholar, but I happen to know one old colleague of mine, not old, but when I used to work in St. Gallen, Matthias Fengler, who I've had quite extensive discussions with about this, and he also suggested volume weighted. Unfortunately, we missed out on a lot of data by taking the volume from option metrics. So we did the analysis first with that. Our data set became really small. And so I emailed him and asked him how bad of a bias it would be to introduce just an equal weighting. And I got the blessing that for my purposes, it's okay. I'm not sure how different the results would be with volume weighting, to be honest. But it's something we struggled with for a very, very long time. Not sure this is a great answer or satisfying in any way, but we just lost a lot of data by doing the volume weighting. So at least this was to motivate why we think risk may play a role in this. Of course, we need to look now at what's in these baskets in terms of size and sector. Lisa, I took the note of that. One other thing we decided to include beyond risk, which I think I haven't seen in the sustainability literature before, is to include a measure of ambiguity. And the difference being that risk refers to probabilities of outcomes where the probabilities are known, whereas ambiguity refers to cases where we may not know the probability of these outcomes. And there's a large theoretical and experimental literature about ambiguity and ambiguity aversion in the microeconomic and behavioral economic literature. It's starting to make its way into the financial economics literature as well. And there are some recommendations for how to estimate this notion of ambiguity in the asset markets, which seems quite difficult. But let me motivate first why I thought that was interesting to include here and see what happens. So the first is a sentence I came across in I think this is the famous Ellsberg paper that introduced the ambiguity aversion experimentally, at least, where he writes, I think it's a he, not a she. It can be understood, ambiguity can be understood as an information state in which information is scanty, marked by gaps, obscure or vague, or on the contrary, plentiful and precise, but highly contradictory. And intuitively, why I thought this connects with sustainability is that when people look at sustainability information, they may want to have very clear and precise information, or they may want to have information at all. So perhaps a stock that doesn't have a rating, or a rating is a bit ambiguous, or they don't understand what that exactly means, they would perceive it as being ambiguous. So this is just like a non-scientific first step for why ambiguity was proposed at all. But then Julia and I were quite hooked on this idea for a while, and we actually ran an experiment and compared investor preferences for ambiguity and sustainability. And we found that investors perceive sustainable stocks as less ambiguous somehow. So this is a different working paper that we're working on. And then the third thing is, so that's another connection between sustainability and ambiguity. And the third thing is this literature in the financial economics domain that says that ambiguity in the equity market is actually priced. And when one introduces it alongside with risk, we may get stronger evidence on the explanatory power of risk and ambiguity of expected returns. And the proposal that we make here is because theoretically, at least, the variance of the probabilities is hard to measure. This paper I cite here, Brenner and Isakian from 2018, I think it's in the JFE, they do that. We couldn't do that, we didn't have the data for that, but we used a proxy because theoretically, I think one can represent this as a sum of the standard deviations of all the moments. So we just took a proxy when we said we take the variance of the variance and call this ambiguity. So this is a made up measure that we have. And this is basically what we have in this picture here. In the bottom.
Can I make a quick comment? The original Ellsberg paper is 1961. And I don't know whether the quote is from, whether this date is wrong or whether the quote is from a different paper, but it's quite a bit more than that.
Thank you. Let me check what I have in here. I'm taking a note. Of course, it's not from 2001. Yes. Thank you. Thank you, Bob. So I was showing this picture here. So in the bottom, in the center, the picture entitled Ambiguity. This is our ambiguity measure for both. So it's the variance of realized volatility and the variance of the implied volatility. So it's an average of these two for our different baskets. And we see a pattern there as well. At least we can say the first and second deciles, so the top 20% rated firms have lower ambiguity historically over that 2.5-year period than perhaps all the other ones, or all the ones in the with worse ratings. And again, I'm pretty sure there's better ways for measuring that, but this is what we can do with what we had. Now, that was all to motivate uncertainty. And now we want to motivate why sentiment may play a role. So this is another paper Julie and I are working on. Well, first of all, there's plenty of evidence now that investors do, in general, prefer sustainable stocks, and for reasons that are not directly related with money. So the two widely cited papers here I have on top. And so the second thing we see based on this other project we're working on is that, at least in the COVID crisis, sentiment for sustainability increased dramatically. What we show in this picture here is just the ESG Google trend, so how many people, the volume of the search ESG in the United States. What Julia and I are doing is we're looking at institutional investor sentiment. We see a similar picture. We're using news analytics, and you see a similar picture, and we're actually doing now a proxy for retail investor sentiment based on Google Trends as well, and we see a very similar pattern. So we see that sustainable stocks, people were seeking them out somehow during the crisis, and that's one of the main reasons why we thought maybe it's encoded somehow in our sustainability measure. So how do we capture uncertainty and sentiment now, at least empirically, econometrically? We are going to take, for the big uncertainty measure, we decided to include risk and risk attitude, as well as ambiguity and ambiguity attitude. So risk is just realized volatility. Risk attitude as a proxy is implied volatility, and then we take one proxy for ambiguity, which is the square root of the average of the variances of the realized and the implied volatility. So this idea again, the variance of the variance representing ambiguity. We don't average them, they're highly correlated. We take the first principal component of them, and we call this our uncertainty factor of firm I on day T, which is just a linear combination of its realized volatility, its implied volatility, and its ambiguity measure. And we call this our uncertainty factor. Sentiment is a lot more tricky. I would ideally like to use something along the lines of, I don't know, news analytics or institutional investor sentiment. Based on the data and the limited time we had at the time, we used measures similar to the ones proposed by Baker and Borgler, which is to take the first principal component of several financial variables, financial market-based measures that represent or can be used as a proxy for sentiment. Things like liquidity-related measures like the bid-ask spread and volume, dividend yield and price earnings ratio has been used before as well, something that captures the valuation and the momentum of the stock. This is highly controversial, as are a lot of other sentiment measures, but again, it was what we could do with the data that we had, and we saw some pattern that I show on the next picture. So here, this is our uncertainty factor for all the firms in our sample in the dashed black line. And in blue, it's for the uncertainty, the average uncertainty factor for all the top rated ESG firms in blue, and in red for all the bottom rated ESG firms. So firms that have higher sustainability ratings have lower uncertainty, lower realized risk, lower implied volatility, lower everything that we put in there in the uncertainty. The same picture in the bottom is this, our sentiment factor, which is a lot more noisy for all the firms again in our sample. That's the dashed line. And then for the top and bottom decile firms in blue and in red. And here, I was having a hard time interpreting it, but I think also based on some analysis we did, we see a bit of negative correlation between the red and the blue based on separate regimes. So if there's a regime, there are certain regimes where people are more into sustainability, or at least the sentiment is higher, and then the sentiment is lower for the worst ones. So these are the components that in our first hypothesis where we say ESG is factor plus factor with some constants and an error term in the end. These are the two main factors that we use. And now our approach. How do we say which factor plays more of a role, or how is it associated with this? We take our average ESG score in the first step and filter out everything that we think is firm intrinsic. So the size, idiosyncratic volatility, its sector, some fixed firm and months fixed effects, leverage, cash, return on assets, book to market. So this was a discussion with Julia about what is traditionally being used in the corporate finance literature. So things that are not necessarily market driven, but they're in the firm and they're the ones that are known to be correlated with sustainability. That's our first regression. So we filter out all of this. We take the residuals from that first regression and then take these residual, regress them against our two factors. And we get these betas. These are the coefficients. I think I've asked you the question in the past, Lisa, if it's, it makes sense to me to do it in two steps, this regression, because of the collinearity issue that may arise if I put everything in one. But
there's different ways to handle that. Maybe some on this call are more expert in that than I, but what you're doing here is effectively ignoring you're ignoring potential correlation between the variables in the second regression and the variables in the first. Is not taking account. I mean, there's lots of ways to deal with this sort of thing, and they all have strengths and weaknesses. Probably not a great time to talk about it now, but kind of noted what you've got here, and definitely can look at other methods as well.
So I've included, just for completion, the first regression results, which is just a side note to me and at least to the paper. So things that are correlated, this kind of confirms a lot of the other sustainability literature we've seen. Size and sector, idiosyncratic volatility, firm fixed effects. These are the things that stood out, and size the most, actually. So just another reminder that we need to look more closely at our different baskets.
Ola, on a related subject, you've got a big size and a not very much according to this thing on sector, but tech firms are dominating size. Just the biggest five companies are Microsoft, Google shares A, or Google shares C, Facebook, Amazon, and so on. So, I mean, it might be in your first regression.
Yeah, thanks.
Another question, just back to the ESG average score. Do you standardize to take the average? Because like they don't have the same range from
yes,
CBL.
We do. So Yeah, sorry. Everything is standardized in the regression.
Everything is standardized, and the
Everything is
regression
standardized.
is actually panel regression or cross-sectional.
This is a cross-sectional regression, if I understand
So
correctly.
at each date, a new regression.
No, sorry, that comes later. No, this is a panel regression, right?
Okay.
Getting my terminology right.
Okay.
Yes.
Okay.
Yeah.
So, okay.
No, not every.
Oh, okay. So I have just one thing from what I saw in TVL data specifically. The volume, I mean, I saw that the volume was one of the ones with the highest correlation with any like size or other measures. I don't know if it actually adds some of the size effect. Maybe
Sorry,
something.
the TVL volume measure, which measures the number of news articles on a given day.
Yes, correct.
Okay.
It's
Highest
very
correlation
size
to
biased.
size. Okay. So that's not in here. It's not in our ESG measure. We used Insight, which is the smooth version of the daily.
Okay, so there's okay.
Yeah, volume and momentum don't appear in here.
Okay, thank you.
Yeah, but thanks, and yeah, it's good to know. Because we're looking at volume and momentum for right now. Okay, thank you. Now, this is the second regression where we take the residuals out of the first one and see how much of these can be explained by uncertainty and sentiment. The first column called 1, full sample, this is the regression defined here using our entire sample of firms over these 2.5 years. And so we see a significance. And in terms of variance contributions, which is in bold, we see that they almost equally contribute to this ESG score. And I just wanted to make a side note here. Again, I think I mentioned it before, we're not trying to predict anything. We're just trying to understand if there's information over time that is in there. So we did this regression, sometimes lagging in both directions. And what I'm showing here is the T's are matching. So it's in this month, this is the uncertainty factor, and this is the ESG score for the same month. The results, again, don't change as much when we lag back and forth. What we did out of curiosity is we ran the same regression on a sub-sample of the top-rated firms and the bottom-rated firms separately. And what we see here is that the uncertainty component becomes more significant and explains more of the sustainability term compared to the sentiment component. So these are, for example, in column 2, this is the same regression. We take the residuals from the first, but we're throwing away everything that's not in the top decile. So we only have 2010, almost 10%, actually exactly 10% of the data that we had in the first by considering the full sample. And we get more explanatory power. So to me, it seemed quite a jump from 0.071 to 0.341. So it seems to me that there's more information regarding uncertainty and sentiment and things that are either that are really good, that have good ratings, these top-rated sustainability firms. One other thing we were interested in is if we have actually captured everything there is to capture about sustainability, and the answer is no. So we've looked at the residuals that came out of the second regression. So after taking out all the firm fundamentals and the 2 factors that we think play a role, we looked at the residuals of that second regression and found, just from these plots, we didn't do a serious statistical analysis here, just a bunch of MATLAB plots that shows that things are not symmetric. So in the residual distribution, The middle plot shows the residual distribution for the firms that are in the top decile and in the bottom decile, so things that have good ratings and bad ratings. And there's asymmetry there. There's still some higher ratings compared to the bottom, and vice versa. And the symmetry plot and the third plot shows us the same. And now, maybe we've missed some factors. Maybe this temporal factor can capture some of this information as well. But for now, we call this the idiosyncratic sustainability factor. So maybe there is something in the sustainability score that is not captured by firm intrinsic variables, that is not captured by market sentiment and the uncertainty component of it. Not sure if we have time to go through this. We did some other things. I'm going to skip over the slide, but it's going to be online. We looked at volatility regimes, and we looked at what information from these E, S, and G scores is in our different factors. But now to the actual event. So that was the first part. We think there is some information encoded in the sustainability. At least I've become convinced after 6 months of skepticism that there might be something to the sustainability scores if we take a more aggregate view of what the market thinks of sustainability. And I don't know how this information became available in the end. Maybe there's, because of the development in the recent years, there is some sort of equilibrium that we're slowly reaching, where sustainability score of the market contains actually some relevant information. And if we, for a moment, think, okay, we agree with you guys, we now try to revisit the crash in light of these factors and ask if they explain anything. And so we carried out the event studies I briefly mentioned in the beginning. Our event of interest starts 5 days before the peak, 5 trading days, the peak being the 20th of February and ends end of March. To estimate the abnormal returns, we take the year leading up to the event. So from 22nd of February to 12th of February, which is again 5 trading days before the start of the peak, the event. And we estimate the expected, we use to obtain the expected returns that we need to calculate the abnormal returns, we use the Fama-French 5-factor model. So Julia tried this also with the CAP-M model. I think we tried it with Fama-French 3-factor model, and nothing changes that much. Again, very surprising to me that everything seems so robust suddenly. And so what we did is at every point in time in the window, we calculate the abnormal return, which is defined as the actual return, the realized return, minus the expected return, which again, we calculate based on this 1-year history leading up to this, that estimate. And then we also accumulate abnormal returns, these CARs for a given period, and that's just simply the sum of the abnormal returns in that given period. So these are the definitions of what's coming later. Again, for completeness, we didn't just produce that nice picture with these deciles in our at the beginning of the talk, but we also we regressed these cumulative abnormal returns, these CARs, against our ESG score with a lot of controls. Size, cash, book to market, everything that everybody else is doing. And we found that the ESG remains significant even with all these returns in there. And it's mostly significant when we just look at the period of downturn. So we stop the minute the market recovers, we get a lot more significance in there. So this is the second column, CAR minus. It's just the CARs in that downturn, and CAR plus is the CAR in the upside when the market recovers and goes up until the 31st of March. Of interest to us now is, what do our factors have to do with the crash? So the first thing we did is we came up with, for each firm, a score of uncertainty, sentiment, and residuals based on the endpoint of our estimation window in 2019. So And then we ranked our firms based on these factors. So in the first picture here, the quintile 1 contains all firms that have had the least uncertainty in 2019. So we're not now ranking with ESG. We're saying we want to look at all the firms that in 2019 have had the least amount of realized risk, implied volatility, and ambiguity. Quintile 5 had the worst risk, so the highest. Same for sentiment. Highest sentiment is in blue, lowest sentiment is in this bright red orange. And we even took the residuals. We say if we take everything out, the fundamentals and our 2 factors that we really like, and we continue scoring our firms according to that residual score. Quintile 1 would contain the highest score, and quintile 5, again in the bright red, the lowest score according to them. And then we plotted at every point in time these cars. So we carry out, these are actually cars, right? At every point in time, we calculate our estimated cumulative abnormal returns, an average over all the ones in the firm. And we found that firms with lower uncertainty profile in 2019 have had a better abnormal return performance during the crash in 2020. So this is again starting 20th of Feb 2020. Same with sentiment. Higher sentiment led to higher cars. Higher residual score led to higher cars. This is just a diagnostic look into what really interests us. So instead of regressing now, like we did here, the cars against ESG, if we think that ESG is fundamentals plus a bunch of factors, we're going to regress these returns against our factors directly. So we take out the ESG score from this, the first line here, and we replace it with 3 lines: uncertainty, sentiment, and our idiosyncratic score, the residuals. And what we find here is that uncertainty is the one factor that's most significant in the entire period. So we divide up the period again into the entire event window: crash, the downturn, and the recovery. Second column is just downturn, third column is just the recovery. We also regress maximum drawdown and draw up over the event window against each of these factors. And in the entire event window, and especially in the downturn, uncertainty seems to be the one mostly significantly correlated with the abnormal returns, as is the idiosyncratic factor. Sentiment, we almost see nothing throughout. And our interpretation of this is, if we're trying to do a sort of attribution of sustainability. So similar to what we do when we do return attribution, we want to understand where these returns are coming from. We do the same with the ESG score, the abnormal returns there, and try to understand where are these abnormal returns coming from. Is it from the firms that have the largest size, or is it from other fundamentals, or do our factors explain most of it? And this is sort of the core of our paper. Here we plot at every point in time the coefficient of our regression of cumulative abnormal returns against ESG, our ESG score, which is the blue line. Again, the controls have been taken out as usual. And we see the picture that I showed at the very beginning, that there is some outperformance for ESG. So this is the coefficient gets higher the deeper we are in the crisis, and then it goes a bit lower again towards the end of March. And now we do the same thing and say if ESG is equal uncertainty plus sentiment plus idiosyncrasy, we're trying to get that attribution out of there, how much is coming out of the different factors. And so we plot the same for uncertainty, which is the top with the little stars, for sentiment, the black line in the bottom, and for the idiosyncratic ESG. And the way we interpret this, I know, Lisa, I've showed you the picture before. We're trying to transform this picture into a proper return attribution picture, so that's a bit more intuitive. We're also at the error bars. But our explanation is that this outperformance that people are seeing, the main thing driving it is the uncertainty component that's intrinsic in these firms. So really firms that are viewed as low risk, that have realized low risk, where implied volatility is telling us it has low risk attitude, that have low ambiguity, they have proven to be most resilient. And for some reason, sustainability scores encode a lot of that in them. They tend to give firms with low uncertainty pretty good scores. Sentiment, we don't see as much here, and I'm suspecting that it's an issue with our indicator. I would be curious to use something that's not based on these financial fundamentals and see what we get out of there, which is something Julia and I are working on. So now, what does this bring us? It started by, I don't know if I should stop here before I summarize, because we seem to have a bit more time. Okay,
Yeah,
so
Ola and Julia, do you have a slide here showing which firms these exactly are?
no, not in here.
Yeah, do you know? Is it in your
No,
paper?
we did, but maybe I know where you're going. But something you, no, I don't know. No, but something we did is we tried to remove certain sectors. So we did the entire thing. We removed Julia, we removed tech, we removed energy, right? What else have we removed? So we've tried to remove various things at the same time or one-on-one.
Tried to account for the oil price crash, and that's why we removed all the companies involved in that sector.
Yeah, I mean, it'd just be interesting to see the top 10 in a table. Sometimes that suggests something, sometimes it just pushes you in the wrong direction, but I suppose
Sure,
I'd be curious to see that.
Yeah.
actual firm names, right? Not just sectors and size, but actual firm names.
Totally, yeah, firm names. We want to know who did it.
I'll take a look.
Hi, Ola. I also want
Hi.
to suggest maybe some interesting firms would be ones that are very good with ESG, like have a high ESG scores, but are, their stock has done poorly or has been very volatile. Solar City comes to mind.
Okay.
Got bought or got saved by Elon Musk, and but that's kind of before your data period, but there might be some in the period which. So I think that what is happening with them. So the uncertainty factor would, the ESG would not be able to save it, right? The fact. I imagine, I know the ESG scores are not just on the purpose of the firm, right? So I don't know how high Solar City would actually score on ESG, but I'm sure there are firms that do well on ESG, but on other financial metrics or uncertainty sentiment.
Right. No, very interesting. Yeah, so let me quickly sum up. It just started with huge skepticism, and I think I almost want to say, unfortunately, I personally, I mean, Julia is the sustainable finance scholar, and we have these discussions all the time. I tell her, Julia, this cannot be true. None of this is true. And she tells me, just look at the data. And so this is what we did for 6 months. And I think what the conclusion I've come to is that these sustainability scores that are hugely divergent, and if you look at them together, there is some important information in there. I think this is the main thing I took out of that project, and that's why we call it the anatomy of sustainability. There is a common denominator to what it means for a firm to receive that score. And again, I'd be interested to understand why, like Lisa was saying, there's a lot of things happening in the market right now, lots of different rating agencies. In aggregate, there is some information there. This is my main takeaway, and perhaps to a large part, it may explain the immunity through this uncertainty channel. And one of our theories is that just firms that have been most resilient in the past tend to be more resilient in the future. That investors perceive sustainability as less uncertain. I borrowed this Rumsfeld, the unknown, so that based on our experimental evidence, at least people seem to think they're, or associate less uncertainty with them. Maybe the uncertainty channel comes from this thing I mentioned in the beginning, that people, when they want to see sustainability ratings, they want to see clear information. So the disclosure and the transparency leads to, the quality of these leads to less ambiguity perception of the investor. And even though, well, it has been going on for 6 months now, we really want to extend the data and look at previous crises. I don't know how realistic that is, but if we can go back to the 2007, 2008 crash, I'm very doubtful. We wanted to do a more thorough analysis of all the other sustainability ratings, because like I said, we looked at Sustainalytics and MSCI, but we want to combine and compare all of these together and see if we see the same thing. We want to explore these different factors as well. I think I'm sort of now convinced about uncertainty. I want to understand more what sentiment brings us, and whether or not there is this temporal factor. So if it's really true that people have a perception that these green companies are for the long haul and not just something they want to flip very quickly. So these are the types of things Julia and I are working on, or hope to work on at the moment. I think I'm done, almost, yeah.
Yeah, well, thank you for a beautiful presentation, and thank you both for writing such an interesting paper. Do we have more questions for the speaker?
I had another question / suggestion, which is where you said that maybe it's the sentiment score. You said, you'd already said that this is not causal. You're kind of just seeing if there's any correlation with data. Does the sentiment score mean that investors are perceiving these companies as, so companies with high ESG ratings as less risky or have positive sentiment associated with it? Or could it be that the ESG vendors see companies with high sentiment score and give them a higher ESG rating? I know that's not explicitly in any of their methodologies. They never say we're doing that, but maybe.
I wonder about this myself. I'm quite unfamiliar with these rating agencies and what they do. They may see large companies that have lower risk and there's lots of attention to them in the news, and they say, okay, well, we're following the noise and we're giving them that score. We're very cautious in the paper and in our analysis not to make any causal statement like that, because we don't know. We see it both ways. Like I said, when we did the lag, we see the association. When we match our T's, we see the association. Yeah, I don't know. I don't know what these guys are doing. Yeah.
Well, thanks for a great talk.
No, thank you guys for clicking in. I don't know if there are more questions.
More questions?
Just a question about the abnormal returns and cumulative abnormal returns. Is there an adjustment with the size, or is it equally weighted for each decile?
You mean within the basket when we average
within
over
the
them?
basket? Yes.
Oh, Julia, I think we control
weighting of the abnormal returns.
It's equal weighted, right?
Within each basket, yeah.
Oh, but that's interesting.
Yeah, like,
So if we cap weight them, that's your question, right?
yes, correct.
Yeah, good point.
Cap weighting the cars within each person. Thanks, that.
More questions? Well, then let's thank the speaker. We very much appreciate the talk. Ola, it was fascinating, and Ola and Yulia really look forward to getting more deeply into your paper. I've discussed it a bit with Ola, but not as much as I'm hoping to. And seminar participants, thank you very much for listening today. This time next week, Samim Gamami is going to talk about the impact of collateral and stays on financial stability. And until then, I wish you a good week and stay safe out there. Okay, everybody?
Thanks, Lisa.
Thank you.
Thanks, everyone.
Thank you very much.
Bye.
Bye.